Now the next is about the Asian financial crisis in 1997 and 8. This crisis followed a period of economic expansion in the region, financed by record private capital inflows. So bankers from the G10 countries actively sought to finance the growth opportunities in Asia by providing businesses with a full range of products and services. This led to a domestic price bubbles in East Asia, especially in real estate. Like you go to Thailand and Indonesia and all this kind of, and Korea as well. And then all of a sudden, the bubble bursted. And then accordingly, the currency crisis as well as this debt crisis happened. Businesses, not only that, real estate, but if you look at the South Korean companies, they had a lot of trouble in their capital structure. How did they finance their money, for their projects expanding into global market? Well, they financed with debt, right? Debt financing. If you look at their, debt for invested capital ratio, which is book value of debt divided by book value of debt plus book value of equity, then this is what they looked like from 1981 to 1997. You see Hyundai Motor, LG, and then Lotte, and then SK, Kia, Hyundai Construction, and Samsung Electronics. All of these guys were clustered around this place, which is really close to 1. Well, here is like 0.9. What does that mean? 95% of your asset, invested capital, is coming from borrowed money, doing business with borrowed money. And your equity, only 5%. So leverage ratio, right? Debt to equity in book value terms is like what's that? Like 1 to like 95 to 5, which is like what? 19 times, right? It's like a bank or something. Heavily leveraged position. Why did they do it? Easy money from the government guarantee. Their debt capital structure was very, very terrible. Why were they able to do it? Because the crony capitalism. You are, let's say, Chung Ju-young, and then the government is your friend. And then the corruption goes on. You bribe the government officials so much so that the government guarantees when you borrow from the commercial bank, the bank looks at the government official and then say, oh, you are guaranteed by the government or something. You're close friends. So here's easy money for you. Borrow it, borrow it, borrow it. So from the equity holders' point of view, Chung Ju-young, right? No reason to raise equity. It's easy. Bank money is available for you. Why would you ever do your business with your own money? They used to say like, it's the stupidest guy or dumbest guys doing their business with their own money. Which means a lot of moral hazard. Screwing up the taxpayers' money because you are taking so much risk with these depositors' money in the end, right? Bank borrowing too much. A lot of moral hazard was going on. One company is quite exceptional in this capital structure. So their book value based leverage ratio is exceptionally low, which is like 0.4 or something. They were majorly doing their business with their own money, which seems like a stupid thing, but what is this company? Which is called Yuhan Corporation, which is really famous for, they have a strong reputation of doing good business in terms of ESG or their ethical behavior or decision making. That showed up in their capital structure. You learn from this one. The capital structure shows it. Over here, right? Yuhan Yangheng, very model case. But the majority of the corporations in Korea, including our good old friend Samsung and Hyundai, were on this side. Now, that's 이병철 and 이건희's period. And then 1997, Samsung, let's look at their capital structure. Okay, that book value of debt over invested capital ratio. It was like 80% or something. And they got hit by the financial crisis. And then what did they do? They speedily lowered down their the debt to capital ratio, right? Down to 10%. Like so fast, right? They were following the government regulation or IMF guideline, right? So fast. They were nimble enough, right, to adapt to this new environment. That's one of the success factor. Not only this guy's strategic decision to focus on the the memory chip business, and then try to restructure to focus on hiring the top quality talents from the South Korea, and then try to be excellent in every aspect of their business. But also capital structure wise, they were really fast in adapting to this environment. Other companies were just hovering around and then were slower and got screwed up even more, and then got bankrupt somehow, got into a lot more trouble. But that's what happened in South Korean capital market, in the corporations in terms of capital structure. You see this Yuan Yangheng, this pharmaceutical company. They were rather well positioned even before the financial crisis, and then their borrowing ratio is much lower than their other companies, right? Now, the Asian financial crisis. Additionally, the close interrelationships common among corporations like chaebols and the financial institutions in Asia resulted in poor investment decision making, easy money, easy credit, moral hazard. The Asian crisis is only the latest example of bank making a multitude of poor loans spurred on by competition from other banks to make loans in the hot region. Okay, there were a lot of how do you say, if you look at not only the chaebol sector, but also if you look at the financial sector of Korean companies, like all these banks like Waehan은행 or other banks, right? They created kind of a merchant bank slash investment banks like 종합금융사, and they expanded wildly into Southeast Asian like Thailand and Indonesian market to invest in their real estate businesses, because that was hot and in the bubble at that period. But unfortunately, with the burst of the bubble in the real estate business in the Southeast Asia, these financial sector of 한불종금 or 한회종금, like big investment banks of Korea, got bankrupt or got into serious trouble. That was inducing, right? That propagated the financial crisis into Korean market and then exacerbated the situation. And then, also another part of it was Japanese banks, right? They were heavily investing into bubble sectors in this Southeast Asian market together with South Korea. But with the burst of this bubble, they had to pull out their the exposure, shrink down, and then close down their business in East Asia together with South Korea. So that pressured added to the pressure of the credit crunch, and then exacerbated the liquidity in the credit market. So when bad things happen, it happens all together, right? Shit happens at the same time, right? 화불단행, right? In Chinese 4-character words, 화불단행, right? Bad things never come alone. Altogether happens. Now, if you look at the bubble in cryptocurrencies and then the stock market right now, I am worried about it. Okay, when will this bubble burst? Nobody knows. But if it happens, shit happens all the same time, right? So get ready for that. Anyway, and having said about that crisis, let's go into the global financial crisis. Officially began in the United States in the December of 2007. The origin of the credit crunch can be traced back to the low interest rate environment created by the Federal Reserve Bank in the early part of this century. Okay, 21st century. People thought there was a new economy going on. There's a new world has arrived. And then the value, right, of the bubble, right, the value of the companies, internet companies. We are living in a new economy. So the traditional valuation technique never works over here. Good Lord, right? But turns out to be a huge bubble, and it eventually bursted. So that was it. But during that dot-com bubble period, the central banker, right, Alan Greenspan, kept the interest rate extremely low. Okay, irrational exuberance happened, and then that low interest rate regime sustained throughout to survive the crisis of 2001, and then that low interest rate regime exacerbated the bubble in the new sector, which is real estate market in the US. Many banks and the mortgage lenders lowered their credit standards to attract new home buyers who could afford to make mortgage payments at the current low interest rates or teaser rates that were temporarily set at low level during the early years of an adjustable rate mortgage, but would likely reset to a higher rate later on. And together with it, there was George W. Bush administration, propagating for, everybody has to have their own house, right? Dream about your own house, and then we will enable you to have your house. And then subprime, creditors, credit worthiness, right? Subprime guys, you can also borrow the mortgage, and then you can buy your house. And then many of these home buyers would not have qualified for mortgage financing under more stringent credit standards, nor could they afford the loan at the eventual higher rates of the interest, but they still borrowed it and artificially lower rate. These so-called subprime mortgages were typically not held by the originating bank making the loans, but instead were resold for packaging into mortgage-backed securities, something called MBS. There, the securitization was hot in finance world. Okay, together with it, the financial engineering boomed. And then I showed you the textbook about this financial engineering before, right? That was really, really hot. Derivatives market, securitizing and then repackaging all those loan contracts, and then trying to construct some kind of a mortgage portfolio in a new ways. Hopefully the portfolio risk, will be lower, so that compared to the each component loan risk, right? The portfolio risk will be lower for a given expected return. That was their idea. But there was a huge correlation among these loan contracts that they did not capture it properly. And then between 2001 and 2006, the value of subprime mortgages increased from $190 billion to whopping $600 billion. Conceptually, mortgage-backed securities make sense. Each MBS represents a portfolio of mortgages, thus diversifying the credit risk that the investors hold. Okay. But right, when shit happens together. Okay. Portfolio idea was like, shit happens. Well, your shit is different from my shit. It happens differently in different time points, so that we will cancel each other out, right? But to the extent of this credit risk of mortgage, it's the same sector. And once you get screwed up in your neighborhood, you get screwed up together with it. And California is being screwed up. It goes together with New York's being screwed up together. It's the same mortgage sector. And then even further sometimes, right? So shit happens together, right? That was the idea of this crisis. Structured investment vehicles, SIVs, have been one large investor in MBS, as SIV is a virtual bank, frequently operated by a commercial bank or an investment bank, but which operates off the balance sheet. Whenever you see off balance sheet, right, you have to raise your eyebrows, right? Off balance sheet is trying to go under the radar, because if it is on balance sheet, everybody pays attention to it, so that scrutiny goes on, so that you have to be careful about it. But bringing it off balance sheet, right? Taking it off balance sheet means that you try to hide it somewhere in the notes section. Okay, footnote. That's something fishy going on. Okay, always special purpose vehicle or something like that. Never a good thing. Typically, an SIV raises short-term funds in the commercial paper market to finance longer-term investment in MBSs and other asset-backed securities. SIVs are frequently highly levered, with ratios of 10 to 15 times the amount of equity raised. Since yield curves are typically upward sloping, the SIV might earn 0.25% by doing this. Obviously, SIVs are subject to the interest rates risk of the yield curve in inverting. That is, short-term rate rising above long-term rate, flipped yield curve, thus necessitating the SIV to refinance the MBS investment at short-term rates in excess of the rate being earned on the MBS. SIVs must contend with default risk if the underlying mortgage borrowers default on their home loans. The SIV will lose investment value. Okay. Then they created something called the collateralized debt obligations, which is CDOs, that have been another big investors in MBS. And then CDOs, collateralized debt obligation, is a corporate entity constructed to hold a portfolio of fixed income asset as collateral. The portfolio of fixed income assets is divided into different tranches, each representing a different risk class, AAA, AA, all the way down to BB or unrated. Okay. And then CDOs serve as an important funding source for fixed income securities. An investor in a CDO is taking a position in the cash flows of a particular tranche, not in the fixed income securities directly, bonds directly. The investment is dependent on the metric used to define the risk and reward of the tranche. Investors include insurance companies, mutual funds, and hedge funds, other CDOs, and even SIVs, right? MBSs and other asset-backed securities have served as a collateral for many CDOs. Okay, so these CDOs and the CDOs on CDOs, and then in addition to this, MBS created a whole bunch of complicated asset structures, right? They called it structured finance, as if they understand all these complicated web of complicated loan contract structures and fixed income structures. But none of them were sure about, what they were doing it, right? Eventually, they turned out to be toxic asset. Nobody can value it properly. To cool the growth of the economy, right? The Fed steadily increased the Fed funds target rate at meetings of the Federal Open Market Committee from a low of 1% on June 25th of 2003 to 5.25% in June 29th of 2006. In turn, mortgage rates increased. Many subprime borrowers found it difficult, if not impossible, to make mortgage payments in a cooling economy, especially when their adjustable rate mortgages were reset at higher rates. So interest rate by and by going higher, and then eventually the weakest link start to crumble down. By the way, what is this Fed funds rate, target rate? That is, Fed funds is like the Federal Reserve's member banks interbank lending rate overnight, like call rate in Korean terminology, right? 콜금리 kind of things, right? Fed funds. That's interbank lending rate within the United States, major banks, right? And then the Fed funds target rate is like a Federal Reserve. They set up a target, okay, for this kind of overnight rate, very short-term borrowing and lending rate, this interbank rate, okay. They set the Federal Reserve, the central bank authority sets the target. They don't directly say this, it has to be your borrowing and lending rate overnight among you major guys, right? Major banks. No, they just set this target rate, and then afterwards, this banks should follow their guidance like this. Anyway, so that's that. When subprime, right, default snowball, right? When subprime debtors began defaulting on their mortgages, so commercial paper investors were unwilling to finance SIVs. Liquidity worldwide essentially dried up. And then the spread between the 3 months euro-dollar rate and the 3 months US Treasury bills, we call it TED spread, frequently used as a measure of credit risk, increased from about 30 basis points in March 2007 to 200 basis points, 2%, right? Basis points in November 2007, like, what is it? Like a 7 times high, as investors became fearful of placing funds in even the strongest international banks. So they were mutually doubting each other, like that. Additionally, many CDOs found themselves stuck with the highest risk tranches of MBS debt, asset class, right? The riskiest asset class, which they had not yet placed or were unable to place a subprime foreclosure rates around the country escalated. Commercial and investment banks have been forced to write down over $170 billion of subprime debt to date, with as much as $258 billion expected. Okay, and then financial crisis unfold as what's the lesson? At this point, the story of the global financial crisis is still ongoing. In the middle of 2010s, right? Many lessons should be learned from it. The credit rating agencies need to refine their models for evaluating esoteric credit risk created in MBSs and CDOs. I mean, honestly, right? I was in that credit risk summit conference in 2003. After getting into PhD program, finishing my MBA degrees, by the way, and then at that credit rating credit summit, organized by GARP, if you are aware of the exam called FRM, Financial Risk Management, they are the organization of the risk managers giving these exams, right, and then qualifications or certificate. Okay. Now, this credit risk summit, I met a lot of, like 100, more than 100, right? Experts from the industry, right? As audience. I was one of the audience, right? Trying to learn what's hot in this derivatives market. And then precisely what they were discussing was the counterparty credit risk of the CDOs, and then CDS, and then this complicated derivatives transaction. And then the idea about counterparty credit risk is like, easily put, you get into that CDS, credit default swap contract. It's an insurance, right? What if this insurer that guarantees the loan repayment, right? What if this insurer, which is called counterparty, gets into trouble so that the insurer cannot work as an insurance guy to you? Then you are screwed together with it. How to get over it, right? And then in that conference, the speakers were from Lehman Brothers, Bear Stearns, and then UBS, and then all these fancy financial engineers. And then the audience were from S&P credit rating agencies, and then AIG, right? These credit derivatives department, right? Those experts supposedly. And then I talked to, you know, some of my, you know, guys and sitting nearby, and then those, you know, guys from these companies, rating agencies and AIGs, and then they were wondering, like they were, you know, learning from these you know, speakers, and then they said they are not good at, you know, this is their first time, or, you know, this is kind of new to get exposed to these ideas, right? The rating agency guys were like also, you know, just like myself, learning new things, right? And then they were just happy that, you know, this kind of thing seems so advanced, and then so sexy, and then it's going to be a, you know, good business, they would say. But these guys were precisely in trouble, right? AIG, and then Lehman Brothers, and then all these banks, right? Bear Stearns, they were bankrupt or bailed out, and then at the epicenter, right, of the crisis. The counterparty credit risk is precisely what troubled in this 2008 crisis. Lehman Brothers, right, turned out to be bankrupt as a counterparty, and the rest of the guys were screwed up together. Holy cow. Anyway, so don't invest in what you don't know. That's Jim Rogers' message, right? That's where this guy precisely went wrong. And then borrowers must be more wary of putting complete faith in the credit ratings, and rating agencies, they had to be, you know, smarter than that. And then bankers seem to scrutinize credit risk less closely when they serve only as mortgage or originators rather than the paper holders themselves, right? The book over here, right? Who is it? The Neil Ferguson criticizes the bankers in this 21st century bankers. They are much more transaction based. Once they make a transaction to one counterparty, and then they say bye-bye, and then none of my business, even though the loan relation goes on, all right? Or because they securitized, and then the responsibility disappears. So where's that ethic going on? Compared to this transactional relation, transactional bankings, right? The Warburg, right? He was great because he cared about the relationship building, and then caring about the long-lasting relations with the clients, right? So that's what the social responsibility is about, or bankers' responsibility is about. So that's a nice contrast. Another lesson is, as things have turned out, when the subprime mortgage crisis hit, commercial and investment banks found themselves exposed in one fashion or another to more mortgage debt than they realized they had held, right? So they were all sitting on the same bombshells, right? Remember, at one point, Goldman Sachs bankers, right? Tom Montag and his group sold $600 million worth of CDO transactions to their clients. And once they, labeled as Timberwolf deal, right? Once they sold it, what did they say? Internal mail. Boy, that Timberwolf was one shitty deal. Is that your ethical standard of selling your products to your clients? Setting those shitty deals? That's what the Carl Levin, the Republican senator, criticized at the Senate hearing against the bankers, right? So that's one thing to keep in mind, right? And then, so a lot of things as a future bankers, you guys, right? Keep in mind, right? This relationship banking is much more important, right? As we go into the future. Don't try to be transactional and say, once I transact with you, bye-bye, none of my business. No, okay? It has to be more commitment based. So that's something we have to be careful about. Of course, you want to take off the risk Nobody wants to take risk anyway, but there are some part of the risks that you cannot get rid of, right? That's the key message here. All right, so that's that. Summary is self-explanatory. Go ahead and read it, and then thanks for watching, and then see you in the next video. Bye-bye.